Okay, Phil, welcome to another episode of our Lathrop Loans Mortgage and Real Estate Podcast. How are you doing today?
Great. It's a Friday. Always great to get to Friday.
It is a good one, and I believe of podcasts we've done together, I think this is going to be episode 19 officially, which is pretty cool.
Yeah, that's great. Glad to be doing this again.
And we are rounding out the end of June, getting ready for July. So happy July 4th coming up next week. It's going to be on a Friday, which is great. Hopefully we'll have good weather for that and avoid the rain. We'll see. We're going kind of through that northwest summer right now.
Yeah, according to the weatherman, it's supposed to have 80 degrees here in the northwest, at least in Olympia.
So it should be just straight down the middle. Perfect.
Should be great.
Yep. So today we're doing a quick rate update, and then we're going to touch on one popular loan program we've been seeing lately, which is DSCR loans, which is for investment property, stands for debt coverage service ratio or debt service coverage ratio.
There you go.
Okay. And we'll talk about that in just a minute. But first, what are you seeing with the interest rate market and the overall economy over the past week?
Well, kind of the trends this week, the good news is there's more inventory. Now, this is a national trend, so it depends on the market you're in. But there's more inventory out there, which means that should be good for buyers. The other good news is pricing this week has slight improvements. With all the craziness going on in the economy, worldwide and nationwide, it's great to see the mortgage market has some stability. And that is great news because that increases the buying power. So now hopefully it'd be the best time to get out there and try to buy. The other trend is they believe for the next quarter, looking forward, mortgage rates to kind of hold stable. So there's no radical improvement on the horizon. So, now's a good time to buy. And if rates do something crazy in 26, we'll be ready to take advantage of it. But right now, it looks pretty much stable, and it's good to see we're in a improving trend.
So we're kind of staying the course. We're seeing many rates as just below 7, probably. And so we're kind of staying the course. We haven't had much volatility this year so far, and we don't expect to see much for the next 6 months.
Right now, yeah.
As far as we can see from here.
As long as nothing crazy happens. And, right now, the Fed this week stood pat, didn't do anything. So that held the short-term rates stable, so long-term rates didn't have any movement. And the only questionable news is today, inflation numbers came out, which is kind of pushed up, which is not a good thing for mortgages, but it's only 0.1 higher than the expected 0.1, it came out 0.2.
Okay.
So, but that's enough to make a concern out there. But next week, we're full of economic data on a short business week, which will get unemployment numbers out next week, which will have a trend on the activity of interest rates.
So as far as right now, things are generally relatively stable, more or less. And so it's a great time to get into a planning mode, run some numbers, figure out what things are doing. And interest rates are moving a lot. There's a lot of tension during that shopping process and that buying process. And say, hey, I quote you a $2,500 payment today, and tomorrow it's $2,550. And then those fluctuations can make it a little bit stressful sometimes. So right now is a really great time to have enough time to take your time on the decision, have enough time to take your time to make the decision. Kind of redundant there, but you get my drift, is that there's some more comfort in this market to do your shopping.
Yeah, and it's a good time to get in there and compare. If you're talking to your lender and compare.
Yeah.
Because that's what we do, and that's where we feel on the wholesale side have a huge advantage to get you in the best package. And so that's why take your time to do that. And, typically you got this window to buy a home. It could be a month, it could be 3 months, 6 months, a year. It varies for everybody. Everybody's got their own plan going on. We're just there to help you with your timeline and make sure you're in the best position to take advantage of it.
That's right. So one of the things that we've been seeing, speaking of taking advantage of things, is different products out in the marketplace, different loan programs. And this debt service coverage ratio, DSCR, tell me a little bit more about this loan program and how it can be beneficial.
Well, it's a great product out there because, and it's basically designed for buying investment properties. So if you're in the market, if you have a rental now or you want to purchase one or another one, there's different avenues you can get in there. There's the straight conforming Fannie, Freddie, non-owner-occupied option. These programs you qualify a little differently. It's all you need to do, because the debt service coverage ratio basically means if your house is renting for $2,500, your payment just needs to be $2,499.
Okay.
And you're qualified. That's how they qualify. They don't look at all of your other stuff. They only look at the subject property. So it doesn't matter what your income is. So it's a huge differential on somebody trying to buy something if you have other obligations out there, but you have enough liquidity to make it work for owning a rental property. It's a great product, and sometimes the rates are better than the conforming products are. But it's something that you don't hear about every day. But it's if you're in the investment market, or if you want to refinance some properties, it works as refinances as well.
What type of loan to value or down payment are you seeing on these type of loan programs?
It varies across the board. The key thing is credit. Credit score is huge, and every lender has a limit that they might only loan you eight properties up to $3 million, something like that. So depending on what your property values are, what market you're in, makes a huge difference. But it's been a really great tool. I'll use a primary example. I have a client who owns a lot of rental properties. I mean, a lot, most I've ever known. And we don't have to look at all that data. We have it on the credit report, what he has credit or mortgages on, but that's all that shows up. All the other properties he owns free and clear.
And so just to be even more, just for the fun sake of the story, this is an individual with over 150 rental properties.
Yeah.
And so when someone like that wants to deploy some financing, it can be challenging to go ahead and document all 150, 180 properties. So this type of program is perfect for a guy like that.
Perfect, because it makes it so much simpler.
But this is not for your first-time buyer with a low down payment or low equity. This is somebody that's going to have a substantial chunk of down payment or equity to make this.
Yeah. But you can be a first-time investor. That's the other thing, too. You don't have to have all this history. There are some lenders that allow first-time investors to do it. You just have to know what you're doing and go through the details so you understand, you can afford what's going on. But bottom line, rents are pretty strong right now. And so if you can get, the right purchase price on the house, these things work out pretty nifty. But in that debt service coverage ratio, you include your principal and interest, your taxes, your insurance, and your HOA if that's applicable. So that can have a difference on your qualification scenario too, because HOAs can be minimal or pretty large.
So basically you need to rent for more than your mortgage payment, and then it works.
Mortgage payment and the HOA, yeah.
Full all-in total.
PITIA as they
housing expense.
Yep,
basically.
Exactly.
Okay. Well, that's a cool program. And so as far as application and getting started, same process, I'm assuming. You call in, have a chat, make a loan application, review your numbers, and then off to the races.
Yeah, same thing. It's just everything looks the same. It's easier qualification because you don't have to go through all the 28-36 ratio or max 50% on Fannie Freddie, all those details that go in there, and hitting that. So there's these other avenues that can give you some options, and we'll compare the conforming ones too. If you fit that route, so we make sure you pick out the best option for your situation.
Great. Sounds good. Well, aside from that loan program, what are you looking forward to over the summer? We're officially in summer now, so we passed the summer solstice, and we got, 3 months of summer, and then we're going to be heading into Q4 pretty soon. Or how are you feeling?
Yeah. Through the first half of this year, I'm really happy with the volume we closed and the activity level, the way things have gotten done. That's great. The systems work out well, and in conjunction with that, I always want to include that we deal with lenders all over the country, with the sources for money. But it's really nice dealing with your local vendors. We deal with title and escrow companies and insurance agents to make our job a lot easier because they respond very quickly, which makes it very handy. So that's what we like dealing with our local markets. We do loans out of state and stuff too, but all those things are a big plus because we can perform as quickly as they perform. And they've saved our bacon on a couple deals of making things happen. So shout out to all the local title and escrow companies here in the Thurston County market, especially, and local insurance agents too that can respond because it's a challenge, guys, getting insurance today. And you got to have a good agent. And it's not just dialing for dollars in the phone book. I mean, get a hold of people and find some good people to work with, just like our business.
Well, on the service provider thing, if it's someone you're going to interact with frequently, it's really nice to be in the same time zone.
Yes, that's true.
If it's somebody that you're going to do, a one and done situation and get set up, then maybe it's worth looking at all your providers throughout the country. But, I think that time zone, because I've dealt with clients in different time zones, and it's always kind of one of those things where you got to take that extra step of coordination. So if you can do your local stuff, or if you can do your frequent stuff local, then it seems to make a big difference.
Yeah, it's those relationships, because it's not just the time of application. Once you're a homeowner, that relationship with your insurance agent is huge, and because it could be your house, your cars. Turn times, if something does happen, you want somebody that responds, quickly. And I think, location makes a big difference on that. At least that's what we've been told. And personally, I've always dealt with local vendors, which has been nice. And but it all, whatever fits for you is what the key is, because our job is to put you in the position that makes you feel the most comfortable so we can move forward. And we feel that's the case. We can put a great package together, being a wholesale lender that should be able to compete with anything out there, hopefully beat anything out there, and make it, the best package for you.
Great. Well, I think that's going to wrap up our kind of coverage on this episode. And next week, I think we're going to be looking into sellers that might want to get a HELOC to finance their next purchase versus doing a buy before you sell loan program, because you could get a HELOC or you can get a bridge loan. There's some obvious advantages and disadvantages, and the key factor in that is going to be your timing between which route you have to go. But that's something we're going to save for our next episode and get into. If you own a piece of real estate and you want to buy something and take advantage of opportunities that are out there in this market, how are you going to go about doing that? Putting one foot in front of the other if you have to sell before you buy.
HELOCs are fantastic for temporary financing. You can turn into long-term financing later, but to get the transaction at the best possible, price.
Right. So that's what we're looking forward to on the next one, as well as checking in with the market to see if anything has happened between this Friday and next Friday as far as economic news coming out, and see if we're hanging in that zone here.
Something will happen. Well, guaranteed, because as we know, nothing stays the same every week. But we're hoping for positive vibes, because this week's been great with all the crazy news that's come out and everybody's concerns. Everything's finished on a positive note this week. And
as far as financial markets, mortgages, and stock market, it's rallied back too. So all these things are positive, but like it's not a 90-day guarantee. Right.
So you want to be ready to pull that trigger to take advantage, because we saw a bunch of gains in the market this week for mortgages, let's put it that way. And so you get a good rate if you lock in. And because once you lock in, then you don't have to worry about it. And that's the big thing, because rates move quicker up than they do down.
Always.
Yep. So with that note, everybody have a great weekend, and thanks for another podcast, Jeff.
All right, you bet. See you on the next one. Take care.
All right.